Welcome back to the channel. Thank you for tuning in. So on tonight's video, I'm going to show you how to trade the ICT New York Killzone. So this is a trading the ICT New York Killzone video. So when you're trading the ICT New York Killzone, you are looking at 8:30 and 11 a.m. New York time. So the New York Killzone is between 8:30 a.m. and 11 a.m. New York time. So I'm just gonna quickly go in my chat so that I can save as much time as I can, so that we don't have a very long video. We are on Euro USD. So remember, guys, it does not matter what market you're looking at. These concepts they work on everything basically. So you're looking at 8:30. You're looking at 8:30 and 11 a.m. I've already marked my New York kill zone. In fact, I wanna draw your attention to, so at the 8:30 candle there, when the news released, so the news are released at 8:30. On some days there'll obviously be more volatile news than others, and on some days we'll have less volatile news than others. So for this day, the market at 8:30, it quickly, probably like within a second, filled this fair value gap here. So it quickly filled the fair value gap, and then it gave us this huge candle. After giving us this huge candle, we see the market. So I'm on the 5 minute, guys. I'm on the 5 minute. So after making this huge candle, we see the market creating a swing high, and then creating a lower swing high, it then created this swing low, and then it took out this swing high. So there was obviously buy stops. There was buy side liquidity above this high. So when the market was delivering lower prices, forming this low here, this swing low, there was people who were trading this for a sell. So they were actually selling this, and then where would they put their stop loss? They'll obviously put their stop loss above the previous high. So if anyone was selling this anyway from here to 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 here, they'll be confident putting their stop loss above this high. So the market will see that those stop losses, and it will take them out before going down, before the actual move basically. So that is buy side liquidity. Buy side liquidity. Or let me just rather say buy side. Okay, so what this means to us now, we have a swing low, a low that has a lower low to the left and a lower low to the right. As you can see, this low has a lower low to the left and to the right. So after the market takes out this low impulsively with displacement, so displacement is basically impulsively, we have buy side taken out here. So we have liquidity being collected, and then a swing low being taken out with displacement. When that happens, that's a bearish market structure shift. So it's not a break of structure, It's not a change of character. All that is simplified smart money, which is not real smart money concepts. It's I want to swear on this channel. So we have this bearish market structure shift. In other words, um, the price was from 830. Where's 830? From our 830, price was delivering higher prices. As you can see, it went high. It was delivering higher prices. Um, we were actually higher than where we started, where we opened at 830. So we were in a buy program, in a short-term buy program. So as soon as we have this swing low being taken out, that means now the market is in a sell program. Hence, the market structure shift. So there's a shift in market structure. Price was delivering higher prices. Now it's gonna potentially deliver lower prices. So when that swing low is taken out with displacement, in other words, impulsively, we look to see, is there a fair value gap? So this low was taken out by this candle here. It took it out eventually. It took it out and then created the low and then eventually went higher to close there. On a 5 minute basis, it went higher to close. So it opened here, took out the low, moved a bit lower, and then went back up to close. The very next candle opens lower and then it delivers lower prices as well. What did it leave? It left a fair value gap. So there's a difference. There's a difference in price between there's a gap between this candle's low and this candle's high. That is the called the fair value gap. As you can see, the red box is trying to show you the imbalance left in price. There's an imbalance left in price. So as soon as that happens, we have a bearish market structure shift and we have a fair value gap. We want to enter our trade at the fair value gap. Ne? Now we have two fair value gaps here. The red one that I am working on now and this one here. So the question that might come to your mind is, which fair value gap are you looking for? Which fair value gap are you looking to trade? Well, you trade the first fair value gap you see. Ne? So the first fair value gap that price trades to, you trade this one. But you have to put your risk in a manner that if price was to trade to this fair value gap here, you would not blow your account. But you don't expect it to trade to that fair value gap. Ne? Why? Because you can anticipate this to be a breakaway gap. In other words, price is in a hurry that it doesn't have to trade to this gap. Is breaking away from we have buy side liquidity here that just got taken out. So price is running away from that. It just took out buy side liquidity. Now it is going to sell side liquidity. So we have a low here formed at 2:30. So we have a low from the London session. So there is sell side liquidity there. The market will want to trade to that as soon as possible. So when it creates the fair value gap, as soon as it trades back to it, you can be a seller there. So remember, this is how to trade the New York session. So you can be a seller as soon as price trades to the fair value gap. Oh, this magnet thing. Now, remember what I said? You have to put your stop loss in a manner that if price trades this fair value gap here, you don't blow account, meaning you have to put your stop loss above here. Now, that is what ICT taught me when I was new to his concept. So as soon as I learned more, I discovered that you can also put the stop loss above this wick here. That's a gap. So the midpoint of every gap is called the consequent encouragement. So this is a premium wick. I'm trying to be as fast as I can. So this is a premium wick, consequent encouragement, the midpoint of the wick. If if we are bearish, price does not need to close above. It can trade to the consequent encouragement, but it should like kiss it goodbye, basically. That should repel price. Price should find strong resistance here. So I'll be confident putting my stop loss above here, meaning I'm reducing my stop from having a potentially long stop loss, big stop loss, to a much more smaller stop loss that if it got taken out, I would not, I would not kick myself basically. Obviously, I mentioned that you're targeting this sell side liquidity. So as soon as the price trades with that, you can take your first partials there. You can take your first partials there. Or okay, before I proceed any further, guys, the entry is really not important, to be honest. Because I will show you in this series where I show you how to trade the New York Killzone. I will show you different entry strategies. Hence, I believe the entry is not too important, right? Because even after the price trades with this fair value gap, let's say you missed that, or you were too scared to sell that. Price breaks lower, creates another fair value gap in price. Very next candle, it trades with the fair value gap. Right there, you can sell that. So let's say you missed this entry, you could sell this entry. We have a bearish market structure shift, meaning price is in a sell program, and then we have a green candle. So any green candle inside a sell program is an order block. We have a bearish market structure shift here, meaning price is in a sell program. Any green candle in a sell program is a bearish order block. I just saved you so many months of trying to find out what an order block is. So the opening price of the order block, you can sell it. It goes up just by a little bit. We call that a mohawk. So this is when price it over delivers for the sake of spread, so that smart money can sell and then also cater for spread. So but still, that's still a nice entry. You're still entering on the wick. Price continues to deliver lower prices. Okay, before I proceed any further, guys, the first fair value gap, look what time this is. 10 a.m. So as soon as it says 10 a.m., it runs away. This fair value gap that is created here at 10 a.m., that's a silver bullet fair value gap. So at 10:10, we see the market trading to this fair value gap. That's a silver bullet sell. So you see how the silver bullet works within the New York Session Killzone. So that's a silver bullet sell. Obviously, when you're thinking about silver bullets, when you're talking about silver bullets, you can't be measuring, you can't be mentioning order blocks. But nevertheless, to someone who's not trading the silver bullet and yet they're trading at that specific time and price, they will be looking at this order block. Ne? So just note that. So the New York Session Killzone, guys, what I like about it is that there's a lot of things you can do with it. So we have a swing low here and a swing high here. If you use your Fibonacci, you take your Fibonacci from the swing high here formed in the New York session to the swing low formed in the New York session, and then you use standard deviations. In other words, you project how far down can the market go. You can use those as exit. So as soon as, for example, if you sold here, obviously you're targeting the sell side. If you sold here, you're targeting the sell side. But after that, how far can the market go? It can go up to 1.5. It can go up to -2 standard deviation. It can go up to -3. It can go up to at least -3.5. So these are targets. The more the market goes down and meets all these targets, the more you wanna exit your trades bit by bit. So you wanna take partial profits. Ne? You wanna take partial profits the more the market keeps on meeting your standard deviations that you used to project using the swing lows and swing highs formed in the New York session. So that was a beautiful day, as you can see. Now let's go to a different day. So on this trading day, the following day after the previous day we just looked at, again 8:30, 11 a.m. That's the New York Session Killzone. Ne? So you're looking to see what does the market um, do between this period of time that may give you an idea or a trade idea. So you're looking to see what does the market do between this time so that you may take advantage of that. Now for this day at 8:30, we see the market opening here at 8:30, giving us some sort of a Judas swing. So this is like a false move into making traders think the market is going higher. So others will chase this and they'll buy this. The market breaks lower. It aggressively breaks lower, not giving um, on this time frame. It doesn't give any doesn't give us an opportunity to sell yet. That's because the market moves aggressively lower from 940. You can see this swing high being created here. This swing high, we have a lower high to the left and a lower high to the right. Then the market aggressively moves lower. It created an imbalance here. It creates the imbalance there and another imbalance here. The second fair value gap here. So when I refer to imbalance, I'm referring to fair value gaps. Now, what time is this fair value gap being formed? is being formed by the 10 a.m. candle. So at 10 a.m., the market aggressively moves lower. The 10:05 candle confirms the fair value gap, and then this candle at 10:20 is the first candle to trade into the fair value gap. So that's the silver bullet fair value gap. So those who will be trading the silver bullet, they'll sell that. Now you don't have to sell that because you're not necessarily trading the silver bullet for this video. So for this video, I'm not trading the silver bullet. Ne? I'm focusing primarily on the New York session. It's not a silver bullet video, it's a New York session video. So I'm just like bringing your attention to so that you can see how the silver bullet works. Now, I have a swing high here and a swing low here that were created between 8:30 and 11 a.m. I didn't get them a chance to trade this, but at 11 a.m. I'm seeing that okay, the market didn't necessarily give me a chance to quickly enter the market like you saw in the previous day. It just aggressively moved lower. So how can I take advantage of that? Well, I'll take my fib and I'll mark from the swing high to the swing low. Ne? I'm gonna remove all this. And then I'm gonna put this 62, the 79, and then the 70. So I'm marking from the swing high here to the swing low here. So in other words, that's my dealing range. That's the range I'm looking for. Ne? It is the range that was formed in between 8:30 and 11 a.m. Ne? So between 8:30 and 11 a.m., you can wait for the market to create a swing high and a swing low for you. That's your dealing range. When you take your Fibonacci from the swing high to the swing low, and you select your 62, 79, and the 70 level, what this will give you is this levels here, these Fibonacci levels. Ne? The 62, this is a fair value gap. The 62 level will always point a PD array. Most of the time it's gonna be a fair value gap. The 62 level in this one, the first one, will always point towards a fair. It will always point towards a PD array. Most of the time, a fair value gap that you can trade for a sell in this case. So let me just quickly switch off my magnet because starting to the 62 level will always point to a PD array that you can sell. Stop loss above the high that you are using, the swing high that you are anchoring your fib to. So that's where you put your stop loss. Take profits. You'll be using your standard deviations. Take profit. You'll use the standard deviations, but for the sake of simplicity, let us target this low. Ne? I know my Stop loss looks like it's a lot, but really it's not, because I'm still here to share some stuff with you. Né? So the 62, so far I only mentioned the 62. The 62 will always point towards a PD array that you can sell. Most of the time it's gonna be a fair value gap. Other times an order block. There's always something the 62 is pointing to. Now the 70 level, that's the sweet spot. So if you miss the 62, the 70 level, you can sell it. You can sell that as it trades to the 70 level. So the 70, as you can see, it is the one in between the 79 level and the 62. In the middle is the 70. Most of the time, price will not even trade to the 79. Most of the time, it will not trade to 79. Most of the time, it's gonna trade to the 79 using a wick. A wick. You don't even expect price to trade to the 79. No. So your stop loss, again, you can let's say for example you're trading the 70 level. You're not sell at the 70 level. The stop loss, you can be confident. You can be confident putting your stop loss above this candle. This candle that creates the fair value gap, you can put your stop loss above it. So now you see you don't have to put your stop loss above there anymore. Hence I say there's always a way to reduce risk. So you shouldn't really care how big your stop loss is in time. It also is also it's also according to where you enter. Like for example, doesn't matter where you enter here. Your stop loss for every smart money trader, most of them will put their stop loss above this high. So others will enter at the 62. I'd like to enter at 62. Others will enter the sweet spot. Others will enter this fair value gap. Others will enter the consequent encouragement of the fair value gap. But almost all of them will put their stop loss above this swing high. Others will obviously put it above this candle that creates the fair value gap. No. Obviously, you'll have to know where the market is going. A good example is this relatively quite loose. I'd target this relatively quite loose, even though they're a very long way out. There. So price does trade to the relatively quite lows, but it takes a very long time. Though, you get my point. You get the point. Yeah. So I'm gonna show you maybe one example before. I'm gonna show you one example from a different pair before I close the video for a part 2. I'm gonna use a random pair to even emphasize my point that these things work on anyway. A UD CAD. This is like choppy. This is very choppy price action. Anyway, 8:30 to 11. This is very choppy price action. Wow. This is why I don't trade any of these things, guys. I'm not with the euro and indices. I'm gonna close the video, guys. This is very choppy. I'm not even gonna bother analyzing